afternoon. Thanks for joining today's roundtable, Regulatory Risk Management, presented by The Deal and Intralinks. I'm Rhonda Schaffler with The Deal. During our discussion, you're welcome to submit your questions for the panel using the posting feature to the right of your browser. If time allows, our panel will address those questions later in the hour. Regulatory risk management in today's environment is vital, especially in an ever-changing landscape. Banking and financial services companies in particular are faced with increased scrutiny. Additionally, cross-border collaboration with international regulators adds another level of complication. Risk and compliance officers face increased burdens. Joining me today is Barbara Novick, Vice Chairman of BlackRock, Satish Kinney, Partner at Devovoice and Plimpton, and Doug Gordon, Senior Vice President of Strategy and Product Marketing at Intralinks. Let's get started, and welcome all of you. It's great to have you here with such a great diverse background, too.
Thanks for having us.
Thank you.
So let's start with a very basic question, but it might have a somewhat complicated answer. Let's describe the current state of financial regulation. And Barbara, we'll start with you. Have we gone too far or not far enough?
I think, Rhonda, it's a great question, and it is more complicated than it seems because it's a mixed bag. There are certain things we've done too much. There's certain things we haven't even gotten to. And I think it's important on the too much side to really think about what's the cumulative impact of a lot of these regulations. We're very quick to look at an individual item and say, is that effective or not? But when you put things together, sometimes the interaction between them is not what you expected. On the other side of the ledger, there's a number of market structure issues, whether it's with central clearing for derivatives or it's the stock markets and how they open and reopen that we think are very important to address. And even things like in the crisis, housing was so central, and yet Fannie Mae and Freddie Mac are still unaddressed. So it really is that mixed bag.
Satish, your thoughts on that?
You know, I'd like to pick up on one of the things that Barbara said, which I think is right, is that one of the ways I think about the current state of regulation is complexity. It's become a very highly complex, interwoven scheme of regulations, not just in the United States, but also internationally. And for many institutions, you know, they're faced with having to try and work their way through these two sets of, or multiple sets of regulatory requirements. The other thing is still uncertainty. There's still so many open regulatory issues, even though we're so many years past the crisis and so many years since Dodd-Frank has been implemented. But when you look at rules, even like the Volcker rule, which has been adopted, there's still so many open questions, so many things that the regulators haven't quite clarified. There are rules on executive compensation, counterparty credit limits. Those are still not even adopted and finalized yet. So I think when I think about things, in addition to the excellent points Barbara made, I would add in these two other factors, which is this complexity and continued uncertainty, which really makes it difficult, I think, for many financial institutions in the current regime.
Absolutely. Doug?
A few other things I would add. Our focus is on information and the question of information as relates to risk. And I think one thing we see is certainly companies are investing an enormous amount here. They have no choice. In many cases, it's probably the right thing to do because it's getting their arms around and better controlling information that they should do for many reasons. There is, however, from a regulatory point of view, I'm very struck by the fundamental tension between two threads. One is the classic sort of industry regulatory thread, which is layering complexity and prove you can do all of these different things, which is fundamentally a push for more information. At the same time, these financial institutions are being stressed by a global push to prove privacy, to prove protection of customer information. And it gives me great sympathy for many of our customers as they try to wrestle with that trade-off.
A lot of huge demands. And one interesting thing, especially Barbara and Satish, some of the items you brought up, you know, in some ways, regulation talk has fallen off the political radar screen when you talk about small issues. But there's the big issue out there about Dodd-Frank, and we'll hear from time to time we should roll back, we should, you know, blow that up and start over. We have a change coming up politically in the fall. Do you have any sense, how do you advise clients in this climate where we still have all this uncertainty and we could have a very different looking Congress and White House? We just don't know yet.
Well, I think let's start with Dodd-Frank itself. Dodd-Frank is just shy of 1,000 pages. But what people don't realize is it spawned close to 400 studies and rulemakings by various agencies. Not all of those have even been completed, and with about 2/3 done, we're at 22,000 pages of new rules. So, and of course, Dodd-Frank covers lots of things. It covers, things like financial stability with the FSOC. It covers banks and their capital and their liquidity. It covers private funds and derivatives. I mean, there's so many different titles within it. So I look at it as when you have that big a body of work, it's hard not to imagine that at a very minimum, you need some sort of technical corrections bill or some look back to say, do we really get all of this right? Or are there some things that maybe we're a little off? Coming back to what I said earlier about cumulative impact, what things should we, at a very minimum, tweak from a technical perspective? Then you start looking at the candidates and some of the things that they're saying. We have on one side calls for breaking up too big to fail banks. We have calls for a financial transactions tax, layering on many more aspects of financial regulation. And just last week, on the other side of the aisle, they put out a proposal for how to scale back some of this. Put in a 10% capital requirement, which would then allow a bank to opt out of many of these other rules, have that safety net. So I think people are starting to think about, have we gone too far? Should we roll anything back? What things might be tweaked? And how can we get to better results without necessarily gutting the overall concept?
Yeah, I agree with a lot of that. I think that's exactly right. I mean, a lot of Dodd-Frank was really just a vessel. If you look at a lot of the core elements of it, it was a mold in which regulatory implementation, which is still ongoing, as I was mentioning before, could be kind of poured into that mold, and we could see what the structure would look like. So amazingly, that is still an ongoing process. It still hasn't been finalized. It's still taking time to implement and go through and to see what those changes are like. I think for many institutions, it is heartening to now have some of the dialogue around, how should we be thinking about this? How should we be thinking about what 2017, 2018 ought to look like from a regulatory structure point of view. And so some of that dialogue going on, whether it's on those people who are saying roll back aspects or those people who are saying add in, I think that's heartening, and I think institutions are looking forward to having those discussions, because it is rather remarkable when you have this 800-page or 900-page legislation that you didn't have any cleanup or any places where anyone could say, well, maybe that we didn't quite get right and we ought to do that one a little differently.
I guess looking back at the timing and everything that had happened financially, it was just such a moment that we need to get something done and try to right a wrong, and that was kind of the first focus.
I think that's right. I mean, when you look back at, say, the Depression, you had a series of acts that were put in place afterwards. In Dodd-Frank, it was all just done at one time. But I think many of the people who got Dodd-Frank enacted thought, well, that'll be the first wave, and then we'll adjust and we'll kind of go different ways. And it's that second adjustment that really hasn't taken place, perhaps in the way that even some of the original drafters of the legislation may have thought would occur.
Doug, how are clients supposed to prepare for what is ahead and try to manage the expectations of what might change or what might be rolled back or added?
It's a great question, because of course what you like in IT planning is you like as much uncertainty as possible. That maximizes your...
It's good for you.
That's right. But it is, it's a very tough question we wrestle with a lot of our clients, is that they have to make a decision. Are they ready to commit to making big fundamental platform investments where they think this is the way we're going to now operate our business? Because the issues that Satish and Barbara are talking about are so very fundamental to the operations of the business. They're not just compliance questions. That to make the decision that I'm going to organize information in a particular way, you can't do that in a vacuum, and you do have to have a very strong belief. Is this fundamental? Is this just the way the world is going to be for the next 10 or 20 years, in which case we'll make big investments? Or can we get by with something that's a little more transitional and uncertain? And I think what we're seeing is a few different approaches. Certainly there's many customers where what they're coming to us is, can you help me solve this problem in the next 60 days? And we'll figure out how we make it better in the future. And then there's others where we're really in a much longer term dialogue with them about, okay, where are we going? And that they're in a position to come and say, here's our view of where risk is moving over the next 5 to 10 years. Where does your technology fit into that story? And actually do some proper architectural planning. I would certainly say we see all of that at this point in time, and I have nothing but the greatest sympathy for the architects at our customers.
What potentially, Barbara, is an area where regulators should be thinking about risk? What has been left undone which could be problematic to markets?
Right. I would come back to the market structure issues. So I divide them into 3 categories based on the types of markets. The first is derivatives. We created this thing called CCPs, the central clearing platforms. And while we think that they're a great idea and it reduces risk overall, there's a lack of resiliency, I think is how I'd best describe it. We've taken the risk from the banks and we've now concentrated in these CCPs. So some of the risk comes out because there's some netting, it's very technical, but the fundamental risk is still there, and we need to really make sure these entities are now resilient so in a market stress event they can stand strong. Second area is the stock markets, and we saw on August 24th clearly a tremendous amount of turmoil. A lot of that had to do with extremely technical, sort of micro kind of problems in the opening and reopening of stocks. And we and others have gotten together, and there's about 24 firms that submitted a letter to the SEC identifying easy fixes, sort of low-hanging fruit. What could improve stability and avoid those kinds of technical problems going forward? And then the third is the bond market. And there's certainly lots of discussion about bond market and bond market liquidity. I think you have to look at the cumulative impact of the regulation, and you have to say to yourself, did we do this on purpose or not? And I think the answer is we did do this on purpose. So then if this is the new normal, how do you react to that? How do you work within the new normal? And I think one of the areas that we're seeing is with ETFs and bond ETFs really providing a certain kind of liquidity in the bond market that is needed. And really because of the lack of the dealers' involvement, this is now supplanting that.
Interesting points. Satish, when you listen to what some of Barbara's concerns were about market structure, what worries you on the legal framework about what's left open?
Well, I think some of what worries on the legal framework is that there is, as I mentioned earlier, a lack of certainty around a lot of the rules in this area. There's also a lack of certainty because I think many firms would really like to say, okay, if these are the rules, we'll comply with them, but they feel like they don't exactly know what all of the courses of conduct are they supposed to be in one area or another. Second problem, and Doug pointed this out too, is that whatever the rules are, the enforcement environment, the supervisory environment, that's radically changed from pre-crisis. So firms are not in all cases getting guidance on how to interpret regulations, how to interpret new requirements, but when regulators perceive that they may have misinterpreted something, they're getting whacked very hard. And that liability is increasingly addressed to firms, but it's also sometimes now being addressed to individuals within the firms, which I think is a very scary place to be for many institutions and many of the people who are within those institutions. So I think that environment is a difficult one for many.
How does that one get resolved?
Well, it's an ongoing dialogue, and I think that's a good question. I think many people within the industry are starting to raise their voices and say, when we are talking about holding individuals accountable, on one level that makes sense. Obviously, there are circumstances where it may be prudent and necessary to hold individuals accountable, but on another level, particularly if you're talking about, say, holding a compliance person responsible for compliance deficiencies within a large institution, that may not make sense. You may be driving away people who are highly qualified for those positions who will not want to take them in the future. That's highly problematic. So I think it's going to be an evolutionary process as regulators, supervisors, and institutions come to find a little bit of balance in some of these spaces.
And from the personal liability issue, Doug, you have to hope that on the IT side, somebody's going to say, listen, we've got all this technology, we're in place, we should be fine. So it's hard for them to realize, well, wait a minute, why do I have all this? Why we invested in all this if it's still not going to do what I need it to do?
It's a great point. I mean, in some sense, the positive, and I would fully agree with Satish's caution on this, but the positive in some sense is that there's a real focus on some of these issues that do force people to go and do the right thing. I mean, I think for all of us, if you think about process change, and compliance is often just a form of process change, it's easier to keep doing what we've been doing. And to the extent that it focuses the mind to say there are both consequences for my organization and potentially consequences for me individually by not doing the right thing, that is the forcing function to go move towards newer and better ways of doing things. Ideally, companies are able to do it in a way that doesn't in turn constrain the business, that is genuine addition of discipline and speed of execution, which would be, you don't get dragged down by compliance, but I think it is a focusing force. I mean, certainly in the conversations we have with our customers, they are very sensitive to both, from an IT perspective, I don't want to deploy technology that people will just say, I can work around this. But also being very aware of the technology is a core backbone of whether people can meet the compliance requirements that they have.
On technology, I think one of the challenges that some of our clients have, and I don't know if you see this as well, is if you're talking about a particular software to meet a compliance objective, firms will input or address that software need, will do that, or maybe make a rational decision saying, all right, this is not a complete solution, so we're going to not go with this and maybe wait for the next upgrade or wait for the different version of that software. Regulators have, in some cases in those situations, come back and said, well, why didn't you do that? You did it for a cost-saving perspective rather than to be compliant. That's a difficult position because I think it robs the institution of the judgment that they should be making rather than acknowledging that individual institutions are better served by making their own judgments and then seeing how those outcomes play out in terms of regulatory compliance and what they're able to achieve.
Is there any concern, and all three of you can jump in on this, that the cost level of trying to meet compliance, trying to anticipate future regulation is really constraining the business? Have clients figured out a way to deal with those rising costs and budget in a way where they don't feel like it's hurting their business? Or are some firms forced to put in technology that they might not even really need or might not totally make sense, but it just makes them feel a little bit better in case there are some issues?
I will certainly say for us that by far our sweet spot, which is where we like to be, is where you have both a business and a risk sponsor of a particular project. It's a lot easier and beneficial for everybody if you can come in and say, like, there is a better way to do this. And by the way, one of the core justifications for why you should do this today and not perhaps next year may be a risk and a compliance issue, but that everybody agrees this is genuinely a better way to do it. There's not a price of compliance, it's a forcing function to do what was probably the right thing anyway. I can't say that that's always the case. There are certainly situations where there are forcing functions that there's just no choice. We certainly are and we in general would hope to work with our customers to figure out a way that there is actual business benefit. Nobody likes a situation where you're investing for compliance for compliance's sake.
I think there are a lot of cases where institutions are investing in compliance. To some degree, it's necessary, of course, and institutions want to, many of our clients want to invest in compliance. They recognize it's important to get these things right. I think the worry is twofold. One, senior management and others, are they able to focus on the core business, strategies, other things, or are they exclusively focused on regulatory compliance? If that's the case, then I think that may not be the right balance. And I think many institutions struggle with that. The other thing is, as you mentioned, are the costs and the benefits commensurate? Do the benefits outweigh the costs? And who gets to make that judgment? I think some institutions struggle with this concept because they worry that they're not allowed to make the judgment as to costs and benefits, and instead a supervisor or a regulatory scheme is making that judgment for them, and not necessarily always in a rational way. So they're being forced to adopt compliance processes, systems, procedures, tools that may not make sense for their type of business, and that's difficult.
So what I would add is that what we're seeing in the asset management space is a tremendous amount of duplication. So I'll give a couple of examples. In Dodd-Frank, there was regulation requiring private funds to register and to report data. And then it was left up to the SEC and the CFTC what kind of data. So they each came up with a form. And when you apply those forms to your fund range, what you'll find is many of the same funds now need to report pretty similar data 2 different ways to 2 different organizations. But that's only the half of it because we live in a global world. So those same funds might also be reporting in Europe under something called AIF, or Alternative Investment Funds. And each country in Europe might have slightly different reporting requirements under AIF. So you start multiplying this out and you realize that's just on private funds. Take the equivalent on mutual funds. There was something called the KID, which is I forget, it's something investor directive, but it basically is reporting for investors in mutual funds in Europe. And you need to do every share class in every language for every fund. And so you can imagine with a large fund range, you start talking about you're producing hundreds, maybe even thousands of these KID forms for investor disclosure. And while that's all fine at some level, you realize that the KID forms in Europe are then a little bit different than the disclosure in the US or in Canada or in Australia. And as you go around the world, you start realizing that there's no harmonization of any of these rules, either the definitions or the actual data that's being captured, or the method of delivery. So the more we can do, I mean, Doug will music to your ears, I'm sure, the more we can automate and the more we can try and get things to be a computer delivering it, computer to computer, clearly the more cost effective and efficient it is. But right now, as each jurisdiction comes up with rules in this sort of post-crisis period, one of the challenges is there's no harmonization. And that's one of the things we've been talking to various regulators about is, can we start bringing some of these things together and try and rationalize? Because actually, when you think about the data side, the accepting of the data, if you actually want to study the data, compare it historically, compare it from our funds to somebody else's funds, if it's all fractured data and it's all collected a little differently, it loses its value.
Sure,
and so it's actually a win-win. If the regulators have comparable data and compatible data, it's better for them. And for the providers of the data, it's clearly a much more cost-effective and efficient exercise.
Question for you, Barbara, because we've talked a lot about kind of the burdens of regulation and the costs, but you mentioned earlier when you had some concerns about market structure and the proliferation of ETFs, which has helped answer some liquidity issues in the bond market in particular. Have we seen business opportunities from regulation beyond the creation of the ETFs? Have companies found a way beyond the technology providers? We know you are in good shape, but are there other perhaps hidden benefits that we should also bring up that has helped some firms look out and see an opportunity that maybe wasn't available?
Right. You always see regulation causes change. Some change is good, some change is not good, but there's always change. And it affects different companies different ways. So I would take the Treasury market. There obviously was a flash rally, flash crash, whatever we want to put on it. And it spawned this whole investigation. Well, we want to know more about the Treasury market, who's actually trading these bonds and making markets, et cetera. And when the Treasury got the list, I think they, as well as everybody else, had not really stepped back and thought about it. But it was not the list of major bracket firms that you would think of certainly 10 years ago. And some of the firms were maybe household names, and some of them were really not names that you've ever heard. And it was very eye-opening that clearly these, I don't even know that they're necessarily startups, but these smaller firms saw this as an opportunity and have been taking market share in what's a fairly liquid market, and a great example of changing regulation. As the banks feel they can put less on their balance sheet, they want to pick their spots, where can they make more money, they've backed away from some of these things. Some of these new entrants can come in. Same thing with outsourcing, whether it's your middle office or your back office. There's so much that you need scale today. Mm-hmm. And one way to get there is to outsource and use some third-party providers. So you see an increasing use of outsourcing.
Satish, this point about the lack of harmonization, we have in the past, things have kicked around. Do we need the CFTC and the SEC? And then the regulators will come back and say, you know what, we need more people and we don't have enough money to do our job. I mean, this is a constant conversation to have with any agency, really, in many ways. But to the point that there was a lot that happened and a lot of concerns about oversight. Will we ever get to the point where there is a single international regulator? Will we see in the US some of the regulatory agencies combining potentially? Or is that just, are you going to be reporting to all sorts of agencies for the rest of your life? That's really what I'm wondering about.
Yeah, I mean, in the US, we tend every crisis to create new, let 1,000 agencies flourish rather than coming down to one. So obviously Dodd-Frank, we eliminated the Office of Thrift Supervision on the banking side, but we created the Consumer Financial Protection Bureau, we created the Financial Stability Oversight Council, we created the new Federal Insurance Office. So we tend to, I think, in response to crises and in response to perceived public policy issues, create new agencies. There may be, and people have talked for many years about the SEC, CFTC, and doing something with two agencies that maybe should be one. I'm not convinced that that's going to be in the near time horizon. And the track record of some international, some foreign countries that had more concentrated single agencies did not prove much better than our track record in terms of the financial crisis. So I think the answer is, for the US, it's hard to see us really coming down to one financial regulator, and more likely than not, we will continue to have the multiplicity of regulators, and one can only hope that, per Barbara's very good point, that they will, as the regulatory regime matures, they'll start communicating in a more efficient manner with each other and working and harmonizing some of their requirements.
You'll have to work on their technology for them, right? Make sure they're all in the same database sharing some of this information.
I mean, all jokes aside, I think we certainly believe complexity will always be with us, but I think it's in everybody's best interest to harmonize, and so that there can be more focus on the real problems and less about repeating the same thing over and over again.
Well, and there's that issue too about repeating the same thing. Usually it's some new thing that somehow we thought we were protected against comes up, and then everyone's trying to figure out what happened. Why didn't we have the oversight? Why wasn't it caught? Are we better protected overall? Have we sufficiently reduced risk by all these regulatory changes, or is risk something we can never stay ahead of because it changes like the markets? Barbara?
Well, I think Satish's point earlier, it was dead on. We've created a very complicated, very difficult to implement and follow. I think it's even difficult for the regulators themselves. I mentioned 22,000 pages of new regulations coming out of Dodd-Frank. That's a lot to digest. And of course, not all of it applies to every entity, but just sorting through what does it mean, and some of it's very complex. So the Volcker rule was 5 agencies had to get together and negotiate and come up with that jointly. And there's a fair amount of joint rulemaking, so it's good that they talk to each other, and that's an improvement, but it ends up being a very complicated product at the end. I would agree that the SEC and the CFTC, the time to merge them was during Dodd-Frank, right, and there wasn't the political will to do that. Right. So I don't think that that's really feasible, certainly not near term. And on the banking side, Volcker has pointed out there's something called the Volcker Alliance, and they've put a proposal on the table of collapsing the Fed and the FDIC and the OCC and taking all these bank regulatory agencies and putting them together. And of course, in the United States, we have the state banking regime as well as the national. And of course, on the insurance side, we now have this federal insurance office, but most of what our insurance law is state-based. So I think just within the United States, there's room for more efficiencies and thinking about it. How can they either work more closely together and harmonize what they're doing, or merge in some cases? And I think internationally, I think it's less likely to happen. That doesn't mean they can't have global standards and harmonization of definitions and number of ideas, but I don't think you'll end up with one Uber-type regulator internationally.
Does it matter if we have 1 or 50 in terms of preventing risk?
If they can coordinate with each other and work together, maybe it doesn't matter. But I think when you have more regulators, you naturally will have a greater diversity of viewpoints as to what rules mean, a greater diversity of rules, a greater diversity of information collection requirements. And again, that diversity can be a good thing, but if it's diversity only for diversity's sake, that can actually be a very bad thing because it takes the eye off the ball of what we really should be managing. I do think to one other part of your question, which is, are we safer now? I think many large financial services firms are focused much more acutely on risk, are much more focused acutely on the lessons learned from the financial crisis. So there are ways in which we're safer now. Some of that is through regulatory change, and some of that is
the stress tests. Would you mean?
The whole stress test, the capital planning process that the Fed has implemented with the largest banking organizations. Again, there have been some hiccups in through that, but that whole process is a post-crisis process. That whole regime, and there are many other regimes like it, where institutions are just being much more careful about regulatory risk and thinking about risk much more actively. I think we are safer because of that.
One interesting analogy is thinking about from our business, a different side of our business is life sciences and biopharma, where you have really much more centralized regulatory regime. One regulator in the US, one regulator in the EU who coordinate pretty well. And I think much less debate about even what risk means in the subject of drug safety. I mean, you'll always have debates about relative balance, but there's some clarity there. And it is very striking to me if I think about the difference between, I look at our banking customers who really are debating very broad fundamental questions versus our biopharma customers who are very clear what the set of rules you need to follow around drug safety are. And a particular institutional review board might have one perspective and a different IRB would have a different perspective, but there's much more clarity on what the regime is that makes it a lot easier in some ways for people to execute. It's probably a somewhat simpler idea because it is easier to wrap your head around what good is in a drug safety concept than in a banking risk concept, but it is an interesting comparison point.
Mm-hmm. Absolutely.
I would add, though, one area where it's clearly more safe is the reduction in leverage. Mm-hmm. And if you think about the crisis and coming into the crisis, the amount of leverage, whether it was at a bank, it was at a hedge fund, it was these off-balance sheet SIVs, there were all sorts of ways that leverage had crept into the system, and it seemed like free money. Today, leverage is dramatically lower. And so from a safety perspective, most crises, most individual companies or entities getting into trouble, it's a liquidity crisis. Mm-hmm. It's you lose your funding source, you're levered, things are going down. Well, if you have them on leverage, then the price decline is multiplied. And you see that propagates then through the system and leads to the systemic type crisis. So I think the reduction in leverage makes the system safer. I'm not sure if all the new rules necessarily, right, but certainly higher capital and lower leverage, which are related, are, I think, critical for a safer system.
One issue in the news I want to bring up, a little bit away from what we're talking about now, but we can't not talk about the Panama Papers. So, Doug, I'm going to start with you. What do firms learn from in that entire case when it comes to third-party data leaks? What do you do in terms of protection? Because here you are worried about all this other stuff, and then we have something like this happening.
One of the interesting things we're seeing much more focus on from the banks that we work with is this question of third-party oversight, which is I have my customers' data, and we've hopefully done all the right things internally to ourselves, but then we are probably working with a variety of third parties, and even if it's somewhat indirect, am I doing the right things to protect that data as it moves out? And we're particularly sensitive to this as a software as a service provider, because in some sense we are potentially for our customers one of those third parties. And I think in the world where information is extremely mobile, people have to be and are increasingly becoming much more sensitive to the fact that if once upon a time, if a lawyer makes a mistake,
Lawyers don't make any mistakes.
Exactly.
Fair point. If a non-lawyer made a mistake and left their briefcase in a cab, it's a few documents that were misplaced. And whether it's malicious or it's a mistake, the scale that we operate in now is much bigger. And certainly our customers have become much more sensitive and are asking whether it's about us, because we are, in some sense from their perspective, a third party, or it's about other third parties, such as this law firm, they're asking that question. And one of the angles is to say, well, okay, if you're going to hold information that is fundamentally sensitive to my business or to my customer's business, I need visibility into exactly how you're doing that and making sure I'm comfortable with the technology and the processes that you're following. And this is an area even that we're seeing from a regulatory point of view. This is a question regulators are starting, I think, quite correctly, that the cloud has gone from being sort of an interesting thing where people can share pictures of their cats to being very fundamental. Not that there's anything wrong with that, but to being very
Lawyers
fundamental.
sharing pictures of their cats.
Everybody deserves to share pictures of their cats. But to being very fundamental to certain businesses, well, you have to start asking these questions, and it leads to a very different way of thinking about how information is shared.
And Satish, you've got to weigh in on this in terms of just, what are the legal obligations? How are clients viewing some of these issues now?
Yeah, I think the banks, in particular, the banking regulators, have been very clear on and have developed very robust third-party information technology oversight guidelines and expectations, and they are being very adamant that institutions do oversee all of their service providers, offshore and onshore, law firms included. And we see exactly what Doug mentioned, lots of inquiries to us as to how we're protecting the data from our clients. So I think the regulatory expectations are clear. The supervisory reviews of how data is managed, how it's safe kept, obviously are also clear. And of course, given everything that's going on, whether the Panama Papers or through all of these data incidents that occur, I think institutions are acutely aware of what their responsibilities are. People are planning for cyber issues, or have kind of SWAT teams at ready, and really kind of have game plans that they've put into place to try and manage their data and how to deal with data incidents should they occur.
I would assume you're seeing that well in terms of extreme data protection, right? Because the customer is everything. If you lose a customer, that's a loss of business.
Right. I mean, data security is clearly important. We're living in an era of cybersecurity issues. I mean, you see even with central banks, I mean, the SWIFT network being hacked, et cetera. So data security being very, very important. The Panama Papers in particular, I think the real question is more the ethical behavior and less the just data security, but what's reasonable for people to be doing or not doing, and you shouldn't be doing things that you're embarrassed by them being leaked.
We also saw recently, for instance, Treasury coming out with new rules in terms of money laundering. So back to you, Doug, on this. Do clients get a heads up for that? How quickly do they have to ramp up once a new change or rule comes out? Is there sufficient notice? Even if it's not something a firm is overly worried about before, do they suddenly start thinking that way?
So we probably see it a little bit further downhill in some sense after the initial contact, but I think it's a few themes we're seeing around this. One is, needless to say, this is a huge topic. I mean, there is no better way for, if I'm talking about some of the solutions we have as a company to get people's attention than to talk about AML. The second is, which I think is probably to me the most interesting, is a shift in the way that people are thinking about the problem, at least in the way they're using our technology, from this being an investigations question, that okay, there's been some evidence that a problem has happened, how do we put together an investigation and manage that investigation, to thinking of this as an intelligence issue. How do we share information better across the bank such that we can have evidence of risk ahead of time? Which then in turn creates a lot of very interesting issues for the business we're in, which is all about information sharing, because this is a question then of how do you share very private, very sensitive information in such a way that you can draw connections. That, you know, the unit in one place was doing this, that's perfectly legal. A unit in a different place was doing something else that was perfectly legal, but that there's a connection between the two of those that is some evidence that you may want to actually go ahead and investigate. And so that's the way that as people start to think about technology, the big question that they're asking is questions about better information sharing so that they're in a better position to actually intelligence. Mm-hmm. And certainly what we see from our customers is a view, to touch on something Satish mentioned earlier, that the way to get in front of the regulators is to prove, to be very transparent and to prove you are taking this seriously. We've created, you know, we see these financial intelligence units being created that big resources into detecting issues ahead of time and sharing versus saying, let us know when something bad happens and we promise we'll go do an investigation.
Yeah, that's really the name of the game, getting out in front. Satish, I'm curious, what's the biggest question you'd get from clients in terms of managing their regulatory risk? What's their number one concern at this point, do you think?
Well, it does vary from client to client, of course, so it's hard to pin down one particular issue. I think we've touched on a lot of them in this dialogue. I think their concerns are in the anti-money laundering space. So there's a lot of regulatory and enforcement risk there, so there's a great deal of effort going into that area. As you refer to, there's new customer due diligence rules that have been issued. There's a 1-year lead-up time for that. Those are coming out, and I know people will be working closely with Doug's firm on how to get on top of that regulatory requirement. So that's a whole area. I think cybersecurity is another area, not necessarily regulatory risk, but certainly a big risk that's a top of mind for a lot of institutions. And then the third thing I would say in terms of kind of clients and what they're focused on is, again, from earlier in the conversation, you know, once we get past the election and this kind of the silly season of election is over, what are the achievable goals to kind of realign maybe some of where we are as terms of regulation, as Barbara talked about? Where are the places where we're deficient and where are the places where we're maybe overstretched, kind of thinking about the policy objectives for the next year. I think those are the things the clients are actively thinking about right now.
Would you say the same in terms of those policy objectives? I mean, the one thing I think about with regulation is a lot of times it's after the problem's out of the box. So things are running along fine. It might not be top of mind of our elected officials to start working on that. As you pointed out, there's thousands of pages of stuff they have to read. But what would be the ideal policy objective, do you think, at this point in the game?
Well, I think we're seeing right now a whole new wave outside of Dodd-Frank of regulation. So we're in the midst of implementing the money market reforms. Mm-hmm. Those go live in October. That's a whole area of business with many, many changes. You've seen some firms actually get out of the business. There's some consolidation. You see lots of funds being merged or in some way being transformed. So that's one category of, almost think of it as new compliance. Mm-hmm. We're expecting the SEC has 4 proposals outstanding, 2 on reporting, one about the advisor and the separate accounts that they manage, the other about funds and the assets that are in those funds and the strategies that are being used. They also have something on liquidity risk management. They have something on the use of derivatives. So these 4, each one of these is, again, hundreds of pages.
Right.
And we expect all 4 of them might be finalized before year end. And that would be, again, another whole set of compliance and reporting and testing things, testing them up front, testing them in the back, and some implementation period. And of course, we haven't even talked today about the Department of Labor, but they've introduced a new rule called the fiduciary rule, which is transformational for the whole industry. Everybody in financial services that touches any part of retirement is impacted by that. So there's a lot of new rules that I don't think we haven't seen in some of them, we haven't seen the final, or we haven't digested even what's out there yet. And I would expect in the next year and 2 years, there's an enormous new wave of just finalizing those and then implementing those and getting into compliance with things in a new world order.
Is there any way to even know what costs are associated? I mean, the fiduciary rule is a good example because there's been a lot written about the positive implication of that. What does it translate to for a customer or a client? Either one.
That's good. I will admit that for us, we see only a piece of it. So we are probably very much, we get the proverbial iceberg view where we just see one piece of a lot of these changes.
Right.
Yeah, I think the cumulative cost is something that has not been really considered carefully yet. There are costs in terms of the ability of clients to offer products. There are costs in terms of ability of clients to focus on core business as opposed to compliance. And then there are just the dollar costs for clients for the compliance regimes, the hiring of compliance people, all of that. And I think that is something that many in the industry have said, look, we really need to think about what the costs are of all of this, and do these costs, are they making sense for the regulatory regime?
How do you get around that? You raised this point too in the beginning, this cumulative effect. How do you get, if these are all good things that are happening, how do you really get around that cumulative cost? Is that where then we need to eliminate some of the complexity to bring those costs down, or is it something else?
Well, in Europe, they did something really interesting. They have this thing called a call for evidence. And under Capital Markets Union, what they're looking at and looking for is where have they done too much or too little? So are there gaps, are there overlap? Are there things that should be changed? And they've actually asked for input from the public and from the industry. And I think that's an interesting way to go about it because we have so many different regulators. That's difficult to do. But we do have the FSOC. We have forums where you could bring people together and say, well, let's look at these 5 things together, and is that cost benefit justified, and are we really safer, or have we just created complexity and not really gotten a lot of benefit for it? So I think that process would be a healthy one to have here, whether it's done through Congress, it's done through FSOC, it's done through Treasury. I mean, there's a lot of different ways it could get done, but I do think there'll be a point where we should pause and kind of look around rather than just keep layering on
Right, I
more.
was going to say it's layer over layer over layer at this point.
And the federal courts are starting to ask agencies to look at costs. I mean, that's always been a requirement in some statutory and regulatory regimes to do cost-benefit analyses for agencies to propose new rules. But one of the things the courts have also been asking in various decisions is, have the agencies done a cost-benefit review? And in the recent challenge to the FSOC's actions with respect to MetLife and its determination that it was systemically important, one of the things that the federal judge said was that the cost-benefit determination was insufficient there by the FSOC. So I think we are starting to see different ways in which costs are being considered, are being asked the agencies, whether it's in the statute or whether the courts are saying to the agencies, you really need to look at costs. So I think people are grappling with some of these cost issues and starting to think about them.
And are agencies well equipped to deal with enforcement of all these new regulations? Obviously, people want to comply with them, but you also want to make sure when regulations are in place that everyone is complying, and if not, they're going to get caught.
Well, I think from our perspective, the agencies are well equipped. Obviously, different agencies are in different positions and have taken historically different perspectives in terms of enforcement. There is whether you talk about anti-money laundering or whether you talk about other regulatory requirements, a very much ratcheted up enforcement environment. And I think some people in the industry would say that maybe it slides maybe too quickly towards enforcement and a formal penalty against an institution. And again, that's something that probably needs to be considered as to whether we are right in terms of how much enforcement around some of these new rules there is, and whether there are mechanisms through a supervisory dialogue that could help institutions that are trying to do the right thing and may have gotten it wrong a little bit, or whether that should immediately run into an enforcement posture.
That's a good point. In terms of helping with that supervision, what are you seeing on your end?
I think for us, the big thing, very consistent theme across everything we're doing is about driving transparency around information sharing. That the more you remove ad hoc systems and you're in a position to let people actually design processes for how information flows, then you're in a much better position to answer some of these questions and at least hopefully say something to the regulator along the lines of, this was a deliberate choice, we designed this with forethought, planning. Things will still go wrong because these are designed and operated by humans, but at least there's a model, and in a lot of the areas we operate in, you are replacing very ad hoc models of information sharing. So there is an opportunity to simplify that and provide more transparency.
Barbara, how much do you expect that the overall financial industry will evolve based on some of the rules coming down the pike soon, or some that might change in the not so distant future?
Right, it's already evolved quite a bit. So you see these new entrants coming into, whether it's the outsourcing area, there's whole firms that have started up from really a standstill, or in the trading side. You see the increase in ETFs, which are adding liquidity in the bond side. So you're seeing different pockets where there's transformation. The DOL, we expect, will be significant change to many parts of the industry. Too soon to tell exactly because it's just been published and people are digesting it and figuring out how to adjust their models. But I do think you're going to see some wholesale business changes throughout the industry, and we're seeing in money markets that will be effective. It's been an 18-month process, and in October, the landscape's going to look quite different than it did 18 months ago, both who the participants are, because some people getting out of it, what the products are that are being offered. There's just a huge sea change going on.
Potentially, how might some of the products change?
Well, the products are required now to break into several categories. Used to be you had money market funds, and they kind of all looked alike. Today, going forward, you're going to have retail funds, which have different features than institutional funds. You're going to have government funds that have more leeway than some of the prime funds. And you're also going to have this product development going on. There's a number of firms who have launched what we call ultra-short bond funds. Slightly longer on duration and maybe it's slightly riskier in credit quality than a money market, but the intention being to build sort of a product suite that offers higher return as you go out on that credit and duration spectrum. And time will tell, which of these products stick, what becomes popular, what becomes less popular. But again, just a wholesale change and transformation in that industry.
And it is interesting too, in the environment we're in terms of low rate and chasing yield, usually that does bring on more risk. So we want to make sure whatever products are out there, to your point earlier, they're not super leveraged, or the firm itself is not super leveraged. If that is the biggest cause of a lot of our problems, that over leveraging, what's the second biggest cause? We don't have to worry about that anymore, but I'm wondering, what else is the warning flag?
Well, again, I'd put leverage kind of as 1, 2, and 3, but that's probably not going to satisfy your question. I think people do have to think about risks, and it starts even with what's the governance structure of a firm. And so, for example, in asset management, having a separate risk management function from the portfolio function, having the pricing of securities, again, separate from the person who manages the portfolio. And whether you do that with internal resources and different departments, or you do it by outsourcing, I think you need some of these checks and balances, and that's the thing that keeps people out of trouble from a risk perspective. And I think not enough has gone into, I don't think that's regulatory, but that's how do you as a firm choose to organize yourself? How do you think about those checks and balances? How do you make sure things can't go off the rails?
Satish, what's left on that front for you in terms of the checks and balances?
Well, I think, as Barbara said, I think that is a big issue in terms of kind of the checks and balances, corporate governance. The federal banking regulators have been active in talking to the largest banking organizations about that. They've put out not formal rules, but supervisory guidance about kind of risk management standards, comprehensive compliance expectations across complex organizations. So I think there are regulatory efforts here to give guidance to institutions, and institutions have done a lot in terms of learning what some of those deficiencies were during the crisis and making a more robust compliance, risk management, and other regimes, and then fixing compensation practices so that they're incentivizing behavior that's perhaps the bright ones to incentivize.
Doug, thoughts?
Yeah, I think from our perspective, I mean, this is about information transparency. Is all of the things that process change and compliance get driven by the ability to have better visibility of what's happening, greater standardization of what information is available. You're going to ask a compliance officer to actually do their job. They have to be clear what is actually happening, provide them that information, and do it in ways that are sufficiently standardized that people can make intelligent decisions.
It's definitely a tough job to have these days as compliance officer.
It is.
A lot more challenges. If you were a betting man, in terms of easing some of that complexity, let's say over the next 5 years, how likely will that happen?
That's a tough bet. One would hope, Barbara alluded to earlier, there's proposals on the Hill to create an off-ramp from some of the complexity, saying, if you have certain minimum capital, very high capital and other standards that you've met, so you meet some core financial standards, and you can debate what those are, then you get away from some of the other more technical complexities that are around. I think that's an intriguing concept, and maybe there are some ways that institutions that can meet certain thresholds can get away from complexity. Some of that may occur, but as Barbara noted, we're going, it's not just Dodd-Frank, it's also international, it's also all these rules, whether it's anti-money laundering or fiduciary standards by DOL. You don't see that all getting wound back. It seems like
And I would think internationally, I can't imagine the complexity lessening that much.
Right. So I would start on the U.S. side. A presidential election, especially when an incumbent is done, right, 2 terms, you're done, will generate enormous change. It doesn't matter who wins. So put aside whatever your thoughts are on who should be president. Regardless of who is in the White House, you'll have a new Treasury Secretary, a new Labor Secretary, a new head of National Economic Council. You'll have, tradition is generally the chairs of things like a lot of the independent agencies tender their resignation. The president doesn't have to accept them, but it's quite possible you have a new chair of the SEC or the CFTC or both. So personalities do count, and the people are the ones who come up with ideas and implement ideas. So I think part of it is there will be change. Now, the question is the change more regulation or less regulation? And then you get into the whole dynamic of, well, it's not just who wins the White House, but who wins on the Hill. The numbers are such that the House probably stays Republican, but the Senate, there are more seats up for grabs in terms of the incumbents defending seats on the Republican side than the Democrat side. And the current thinking is whoever wins at the top of the ticket probably brings along a lot more on the ticket. So you could see some changes, some significant changes. You could see a split government, you could see a lopsided government. We don't know what we're going to get, but those dynamics will, in either case, create change. That's the one thing we know for sure.
Well, we have to end on that for your final thought, but I want to go down the table. Satish, final thought with some of the comments that we made today.
Yeah, maybe just picking up one thing that Barbara said, which I think is a very great point. You know, the role of the political part of the government in some of the regulatory space has changed, partly because of, for example, the Treasury Secretary being the chair of the FSOC, you know, has much more direct role now in terms of regulatory policy than maybe had existed pre-Dodd-Frank. That will not change, and so that means that as administrations change, as political winds change, regulatory policies are going to change, and that's a more dynamic change than would have occurred in previous eras, because regulatory policy was largely insulated from the political sphere. I don't think that's the case anymore. So I think one of the maybe closing thoughts that I would have would be, I think we're going to see an era going forward where politics are going to rebound into our regulatory structure to a far greater degree than had been the case in the past.
And Doug?
I would tend to agree with that. You know, I think it's one thing we've not talked very much about today, because I think we've been focused more on a different side of regulation, but we see very intensely in Europe the impact of certain politics around much more personal and individual data and how that's handled. Huge impact on financial institutions doing business in Europe. And how it plays out is very politically driven by the dynamics. Brexit will make a big deal for what European, UK banks are thinking about, and I tend to agree. I think politics has returned in this area, and companies are just going to have to plan that there'll be regulation, and they're going to have to manage it.
On that note, we'll have to say the conversation will be continued then in a couple months. But I thank you all for being with me here for a fabulous conversation. And formally, I want to let you know I've been speaking with Doug Gordon of Intralinks, Satish Keeney of Devoice and Plimpton, and Barbara Novick of BlackRock. Thanks so much for watching.
Thanks, Rhonda.
Thank you.